வணக்கம். கோர்ஸ் கான்செப்ட்ஸ். Fund flow statement. Fund flow statement is a statement which is prepared to analyze the reasons for changes in the financial position of a company between two balance sheets. It represents the inflow and outflow of funds, that is, sources of funds and applications of funds for a particular period. The statement of changes in working capital. The statement of changes in working capital is simply called working capital statement. It is prepared with the help of current assets and current liabilities. Working capital represents the difference between a firm's current assets and current liabilities. Working capital is also called net working capital. It is the amount available to pay its short-term expenses. The statement of changes in working capital represents the changes of current assets and current liabilities between two balance sheet periods. The result is either net increase or net decrease in working capital. Adjusted profit and loss account. An adjusted profit and loss account is an account in which all the non-cash expenses, non-operating losses and non-operating expenses with net profit are debited and all the non-operating revenues, gains and incomes are credited. It is prepared to find out the fund generated or fund lost in the actual operation. The result of this account shows the fund generated or fund lost in the actual business of the concern. Asset disposal account in fund flow statement. In preparing the fund flow statement, this account is prepared. Asset disposal account is an account which is prepared to find the profit or loss of the sale of a fixed asset when they are recorded at cost price in balance sheet and depreciation is separately shown in a provision for depreciation account. When an asset is partly sold, the cost price, accumulated depreciation, sale value and profit and loss on sale of such asset is recorded in a separate account called asset disposal account. The profit or loss is transferred to adjusted profit and loss account and the sale amount received is shown as source in fund flow statement. Statement of cash flows. The statement of cash flows is also referred to as a cash flow statement. It is one of the three key financial statements that report the cash generated and spent during a specific period of time. That may be a month, quarter or year. It acts as a bridge between the income statement and balance sheet by showing how money moved in and out of the business during the period. It is one of the three most important financial statements for managing your small business accounting and making sure you have enough cash to keep operating. Cash flow statement is prepared with the three components as per accounting standard 3. First one is operating activities, second one is investing activities, third one is financing activities. The outcome of the three segments may be positive or negative. The sum of these three segments is called net cash flow during the given period. Negative cash flow and positive cash flow. When the cash flow statement shows a negative number at the end, it means cash is lost during that accounting period. It refers the negative cash flow. In the long term, negative cash flow is not always bad one. For example, settling more financial obligations during that period may show negative cash flow at the end. When there is a positive number at the end of the cash flow statement, it shows positive cash flow for the period. The positive cash flow is not always a good thing in the long term. Example, by taking on a large loan, the cash flow can be positive at the end. Positive cash flow is not always positive overall. Unless the overall sources and uses of cash are analyzed, the positive and negative value at the end of the cash flow during that period cannot be assessed. Cash from operating activities. Cash from operating activities indicates the amount of money a company brings in from its ongoing regular business activities such as manufacturing and selling goods or providing a service to customers. It is the first section depicted on a company's cash flow statement. Cash flows from operating activities are a section of a company's cash flow statement that explains the sources and uses of cash from ongoing regular business activities in a given period. This typically includes net income from the income statement, adjustments to net income, and changes in working capital. Cash flow from operating activities does not include long term capital expenditures or investment revenue and expense. This cash flow statement focuses only on the core business and is also known as operating cash flow OCF or net cash from operating activities. Cash from investing activities. Cash flow from investing activities is a section of the cash flow statement that shows the cash generated or spent relating to investment activities. Investing activities include purchase of physical asset, investments in securities, or the sale of securities or assets. Investing activities are one of the main categories of net cash activities that businesses report on the cash flow statement. Investing activities in accounting refers to the purchase and sale of long-term assets and other business investments within a specific reporting period. A business reported investing activities give insight into the total investment gains and losses it experienced during a defined period. Investing activities are a crucial component of a company's cash flow statement, which reports the cash that is earned and spent over a certain period of time. Cash from financing activity. The financing activity in the cash flow statement focuses on how a firm raises capital and pays it back to investors through capital markets. These activities also include paying cash dividends, adding or changing loans, or issuing and selling more stock. A positive number indicates that cash has come into the company, which boosts its asset levels. A negative figure indicates when the company has paid out capital, such as retiring or paying off long term debt or making a dividend payment to shareholders. Common size statement. Common size statement is a form of analysis and interpretation of the financial statement. It is also known as vertical analysis. This method analyzes financial statements by taking into consideration each line items as a percentage of the base amount for that particular accounting period. Common size statements are not any kind of financial ratios. Common size statements are always expressed in the form of percentages. Such statements are also called 100% statements or component percentage statements, as all the individual items are taken as percentage of 100. There are two types of common size statements. One, common size income statement. This is one type of common size statement where the sales value is taken as the base for all calculations. Therefore, the calculation of each line item will take into account the sales as a base, and each item will be expressed as a percentage of the sales. Second one, common size balance sheet. Common size balance sheet is a statement in which balance sheet items are being calculated as the ratio of each asset in relation to the total assets. For the liabilities, each liability is being calculated as a ratio of the total liabilities. Common size balance sheets can be used for comparing companies that differ in size. Standard values for various assets cannot be established by this method, as the trends of the figures cannot be studied and may not give proper result. Comparative balance sheet. A comparative balance sheet is a statement that shows the financial position of an organization over different periods for which comparison is made or required. The financial position is compared with two or more periods to depict the trend, direction of change, analyze and take suitable decisions. A comparative balance sheet analysis is a method of analyzing a company's balance sheet over time to identify changes and trends. Public companies are required to include the information needed for a comparative balance sheet analysis in their quarterly and annual reports. Trend analysis of balance sheet. Trend analysis is also known as horizontal analysis. It is a financial statement analysis technique that shows changes in the amount of corresponding financial statement items over a period of time. It is a useful tool to evaluate the trend situations. The statements for two or more periods are used in horizontal analysis. The earliest period is usually used as the base period, and the items on the statements for all later periods are compared with items on the statements of the base period. The changes are generally shown both in money value and percentage. Trend analysis provides a means to analyze company data over a period of time by focusing on the change in specific line items within the income statement and balance sheet. Trend analysis calculates the percentage change for one account over a period of time of 2 years or more.
Non-operating expenses and non-cash expenses. Non operating expenses refers the expenses which are not related to or not associated to the core business of any business concern. Example, take the case of one company which is dealing with furniture. The core business is buying and selling of furniture. In that case, any expense other than buying and selling of that core business, that is furniture, it is considered as the non operating expenses. And non-cash expenses refer any expense which is not affecting the cash position of a business concern. The best example for this non-cash expenses is depreciation provided for the assets. The depreciation provided will not affect the cash position of that particular concern. So these two concepts are purely based on the nature of that business. They have to decide what are all the business related expenses and which are additional income and additional expenses. So any expense which are not core to the business is non-operating expense, and any income which is additional other than their core business is non-operating income, and non-cash is the expenses which are not affecting the cash position.